So, looking at the detail for the final accounts in the 2014 paper for Yes Limited. We start off with sales. Sales 390,000. We could put them there if we had any sales returns. We'd have sales returns here. And we'd put our net sales here. But in this question, we've got no sales returns. So we can put the sales figure straight out into the front column there. So sales, our net sales if you like, 390,000. And then we must find out what those sales cost us to find our profit, or gross profit. So from our sales, we take off our cost of sales. We've got costs in our trading account. You're only going to come across four really. You have opening stock, purchases, carriage inwards, not in this question, and maybe import duties or customs duties. They'd be your typical costs of sales. So in this question, our opening stock is 20,000. And then we've got purchases. Now we have no purchases returns, or returns outwards. If we had, we'd put the purchases figure here and we'd subtract purchases returns from it and put our answer into the second column here maybe. But in this case, no purchases returns, so 128,000. And then we have no carriage inwards, we have no cost of getting our purchases delivered to us on the face of it anyway, but we do have import duties or customs duties. As we said in the last video, it's because being a shoe shop, a retailer, they've probably imported stuff from outside the EU and there'll be import duties on that. And in this question our import duties are 9,000. So we've got three costs of sales. We add up all of our costs, or three costs, and we get the cost of goods available for sale, 157,000. If we had sold all of our goods, they would have cost us 157,000, but we've got some stock left over at the end of the year. We refer to it as closing stock. This is the cost of our unsold goods. And as we haven't sold them, we must take their cost out of the cost of goods available and bring them forward into next year's trading and profit and loss account. That's opening stock. So the cost of the goods we did sell, or cost of sales, is 143,000. So goods that cost us 143,000 we sold for 390,000, and that gives us a gross profit in our trading account, a gross profit of 247,000. Sales less cost of sales gives us gross profit. Our gross profit was 247,000, and I'm going to add any other income that we earned during the year, and in this case we earned rental income. So we have rent receivable. We received 16,000, but we don't just put down the amount we received, we're also owed another 6,000 due to us. We see that in the adjustments down under the trial balance. So the appropriate figure for rental income or rent receivable is 22,000, bringing us up to 269,000, from which we subtract our expenses, less expenses. And we've got 1, 2, 3, 4, we've got 5 expenses in this question. We've got wages, we spent 70,000 on wages. But if you look at the adjustments down the end, we're told we owe another 8,000. So although we spent 70,000, it's 78,000 will become the expense in profit and loss account. We don't just put in the amount we spent, we put in the amount we should have spent. And then in insurance, it's the other way around. Insofar as this time we spent more than we're going to charge, our insurance was 12,800, a debit entry in the trial balance, like any other expense. 12,800, and it turns out that 3,400 of this has been prepaid or paid in advance. It belongs to next year. So that means that 9,400 is the expense of insurance for this year. And then we've got two depreciation figures. We've got depreciation on buildings. It's 5% of 420,000. So we've got 21,000 for depreciation on buildings, and then we've got depreciation on delivery vans or motor vans of a peculiar 14%, 14% of 170,000, 23,800. With depreciation, you're trying to spread out the cost of the asset over its expected life. So we're putting 5% in for buildings and 14% of the cost of the motor vehicles. And then our last expense is loan interest, €4,000, and that's our fifth and final expense. And that gives us a total of expenses of 136,200, giving us a net profit of 132,800. Our net profit is 132,800, and the dividends we're giving to our shareholders, the shareholders cut out of the profits of the company are 14,000. So we're keeping back, or we're retaining 118,800. We call that our retained profits. To which we add our P&L balance at the start of the year. That's the profit left over from last year, 85,000. So we end up at the end of the year with the P&L balance 203,800, which will be the balance we'll use in our balance sheet. So that's the final accounts done. Our trading account, our profit and loss account, the profit and loss appropriation section down here at the end. What's your last 5 lines? Net profit, dividends, retained profits, add in the opening balance left over from last year, and you have your final balance here for the balance sheet. So all our sources of income, or gains, or costs and expenses, we've put them all into our trading profit and loss account, and they've distilled down to one figure for our balance sheet, 203,800. And we'll go on now next to have a look at Yes Limited's balance sheet.